If you're planning for retirement or already there, one of the most important decisions you'll face is how to invest your money. As a financial advisor, I talk this through with clients every single day because the way you structure your portfolio now can make a huge difference in shaping your retirement lifestyle. So in this video, let's look at 5 ETFs that are commonly used by retirees and the types of situation where each can be a great fit for you. Now, before we get into the detail of the top ETFs for retirees, I just want to go through and define some of the key terms and explain exactly how exchange-traded funds work and how they fit in terms of the economic, the investment, and the superannuation ecosystem. So what is an ETF? And the financial industry is great at finding acronyms for everything. It is an exchange-traded fund, as the 3 letters suggest. There are 3 different types of investments you can use to buy shares. Shares being owning a portion of equity in a company. You can do that directly through a broker where you own and have the complete registration of each individual shareholding in each company. So go to CommSec, buy shares in CBA, for instance. That's the first example. The second is via something like a listed investment company. A listed investment company, as the name suggests, is a company which then buys and holds and invests into shares on your behalf. As a company, that company pays tax at the company tax rate and is able to declare a dividend to you. Exchange-traded funds and managed funds, or in the US, known as mutual funds, are incredibly similar. They are structured as unit trusts, which means when you buy or purchase or apply for units in these trusts, each unit includes ownership of all the underlying assets. So similar to a company, but structured as a trust, which we'll get into a bit more detail later on. The first ETF, for those playing along at home, was created in 1993, and the name explains it quite simply. It is an exchange-traded fund. So in a similar way as a managed fund, and think about how a managed fund works. These days and historically, a managed fund, you must complete an application form to apply for units. You get issued those units on a piece of paper. And to sell those units, you have to complete another piece of paper, send that withdrawal form back to them, and then you wait for your cash to come back. The ETF is very similar to this, different in that the units do not require you to complete a piece of paper. You can just go on to your stockbroking account and buy those units on the ASX from someone else or in the general market. And it works exactly the same way that each ETF holds all those underlying investments and each unit represents your ownership of all those underlying units. You can have anything in there. You can have bonds, you can have shares, you can have credit, you can have all kinds of assets. But ultimately, it's a unit trust. In the case of an ETF, you're able to freely buy and sell these assets on the stock exchange every day. So how does it work, though? An ETF works by offering you one unit, which gives you ownership of all the underlying investments. For instance, if you buy IVV, so iShares S&P 500 ETF, for each unit, you get an exposure to all 500 of those companies. So, for instance, you'd own 8% of NVIDIA, similar amount in Apple, a little bit in Microsoft, and it gradually goes down. And most ETFs track index funds, track indices. So an index is a measure of the performance of the share market or the underlying market that you're looking at. When you buy each unit, a market maker goes out and makes that portfolio for you, stapling together all of those securities, or in some cases breaks that apart when you're selling them, just to make sure that the unit price you're paying and the share price on the ASX is constantly in line with the underlying value of those assets. This means there's no premium or discount to the net tangible asset value of your assets. And this is a unique thing that comes with ETFs. The market maker then sits behind the market to ensure that someone is buying or selling at all times and that there's no arbitrage available. I think the key here is also when you're investing to overseas assets, that is also there to make sure that the local value in Australia represents what the value of the S&P 500 is worth in the US, given that that market can be closed at times when you're trading in Australia. And the key here is making sure your portfolio is well represented. They generally just follow and copy an index, and in most cases, the most popular indexes are being tracked at market capitalization weighted, which means the bigger the size of the company, the higher allocation they'll have within an ETF. For instance, in Australia, an ASX 200 ETF will have as much as 12% in the Commonwealth Bank, and overseas in the US, a US tracking index will have as much as 8% in something like NVIDIA or Apple. What are the benefits of an ETF? Traded on the stock exchange, this is the key. It's so easily bought and sold. It allows you to get more diversification into your portfolio with less money. So you can buy 1 unit or 10 units and get exposure to 500 companies. If you wanted to buy those 500 companies individually, you'd have to make 500 trades. Obviously, that's just not cost effective, and you wouldn't be able to build enough of an exposure unless you had a lot of money, like billions of dollars, to be able to do that properly. This allows you the ability to diversify your portfolio and do significantly more than what, I say, a 50, 100, 100, even $1 million could do. So you're buying multiple assets and you're buying multiple sectors, you're buying multiple companies, you could be buying multiple bonds, all in a single line of your portfolio. Generally, these are lower cost, particularly when they're tracking an index fund. That's why they're called low cost index funds. And in other cases, they're called passive, in that all they do is do what the market does. They don't take a view that this company is cheaper, this company's got better growth opportunities. It literally just tracks what the companies are doing and what the share market and the index is doing and rebalancing as they do. It does allow daily trading, which is quite unique compared to managed funds. And you can also apply stop losses to things like IVV, meaning if you want to automate the sale and you're worried the market might fall, and not this is something we suggest, but you can actually put in an order that says, I want to sell at this price, which with a managed fund just simply isn't possible. There's no need for any special bank accounts or paperwork, and I think that's one of the keys. But what are the drawbacks of an ETF? One of them is the tax structure. So as a trust, ETFs, like any family trust or unit trust, must distribute all income and capital gains each year. That means there's no control over how much taxable income you're going to have, and even if you decide to reinvest, you're still going to be taxed on that income. So if that is a big year and they have to rebalance the ETF regularly, you could get a large capital gains tax bill that comes just from a distribution that you have no control over. They only track indices in the case of most ETFs, so it's very difficult to get an actively managed exposure, which we think is incredibly important for those seeking more consistency and resilience in retirement. Being passive, you're guaranteed the average when you buy an index tracking ETF, which means you have no potential to outperform the market or potential to underperform the market. You're just going to get the market. If it's down 30%, you're down 30%. If it's up 10, you're up 10. If it does nothing, you get nothing. And interestingly, ETFs tend to be more volatile, not necessarily more volatile than the market, but they're more volatile simply because they tend to be more concentrated. They're not taking a view, they're not removing exposures from companies that are overvalued or going through problems. They generally have to change after the fact. The other thing that's talked about a lot in the media at the moment is concentration risk. And that is because these indexes are market cap weighted, they tend to be concentrated into the world's and Australia's largest companies. In Australia, for instance, as much as 53% is in just two sectors, that being financials, but mainly the banks, and the resource sector, but mainly iron ore miners in BHP, Rio Tinto, and Fortescue. In America, it's a similar case that the Magnificent Seven companies, all these companies dominate the index so much that just the top 10 companies represent a significant amount, which means you may not actually be that diversified or as diversified as you think, and you might actually be exposing yourself to more risk. So why use an ETF? And I mean, it's fairly simple. You get diversification in a single line. It allows you to get started investing at a smaller amount of capital, and it allows you to guarantee you get the average return from the benchmark. They are lower cost than active funds. In a lot of cases, they perform better than similar active managers, but they offer an ability to just start building a portfolio from a low cost perspective and then add things around it. Before we step forward, I think it's important to discuss what an asset class actually is. So an asset class is defined as a category of financial instruments or assets. An asset class could be something like property, where you own residential property or you have an investment property. That is an asset class. When we talk about investment markets, it tends to be one of three, which is bonds. And bonds is like a government bond, is simply a loan to the government or a loan to the Commonwealth Bank or a loan to any other corporate like Woolworths. And the other one is shares. And shares represent an ownership of equity in a business, which means you're entitled to future profits, but also any dividends that they pay. They're the key asset class. So now I'm going to get into what are the most common ETFs used by retirees. And I'm just going to do a quick summary of the key parts of each of these. So the first one I want to talk about is the Vanguard Australian Shares Index ETF, and the code on that is VAS, V-A-S. The asset class this invests into, as the name suggests, is Australian shares. It tracks the S&P/ASX 300 index, which means it invests into the 300 biggest companies in Australia. Interestingly, as opposed to the ASX 200, you get a larger portion of medium and smaller companies, being the 200 smallest to the 300 smallest companies in this. It costs 0.07% in a management fee, and that is not an out-of-pocket expense, but that's deducted from your investment in the fund and reduces your returns. It has a 12-month return as of 31 July, around 13.8%, and a 5-year average return of 11.8%, which has been exceptional. It's been a great period for investing in shares. Top holdings are incredibly consistent: Commonwealth Bank, BHP, NAB, Westpac, CSL, Wesfarmers, and even Goodman Group, the Amazon and logistics centre builder in Australia. Income has fallen in recent years. Australian shares, traditionally known for their higher income, only offers 3.3%, but the ETF is one of the biggest, with $20 billion in assets under management in Australia alone. If I have one thing you should know about this one, it's 52% of this ETF is invested just in the financials and materials sectors. This is good for a base level of income, but not necessarily great for growth, given that concentration in two sectors. The next one I want to talk about is iShares S&P 500 ETF. The code for that is IVV. As the name suggests, this invests into US shares only and tracks the massive S&P 500 index. It has 511 underlying holdings, which try to be representative of the top 500 companies in the US, and cost just 0.04% per annum in management fees. 12-month return is about 17.8%, and the 5-year annualized return is 18.1%. And this is the unhedged version. The top holdings, as many people would know, NVIDIA, NVDA, Microsoft, Apple, Amazon, Meta, Broadcom, Google, Tesla, and Berkshire Hathaway. Income much lower in the US. There's always a focus on growth over there. That's 1.1%. And there's $11 billion in assets in this fund. One thing you should know about this one is 40% is invested in just the top 10 stocks, and similar to what the situation is in Australia, which means there's a lot of concentration in technology and perceivably highly valued companies. This is great for getting a technology exposure on the cheap and access to the biggest companies in the world. The next one I want to talk about is a little bit closer to active, but not quite active, and that's Vanguard's High Yield Australian Shares ETF, and that code for that is VHY. It invests into Australian shares, but with a tilt towards those that are likely to pay the highest dividends, and this is why it tends to be attractive to retirees. It tracks the FTSE Australian High Dividend Yield Index, which has 75 underlying holdings and costs just 0.25%, so well below an active manager. 12 months, it's done about 13%. Over 5 years, it's averaged about 14.4%. Top holdings are similar, but not exactly the same as VAS that we talked about before. So CBA, BHP, NAB, Westpac, Telstra, Woodside, Transurban, and Macquarie Group all sitting here. And the income is significantly higher at 4.7% plus franking, majority of that coming from dividends. Is significantly smaller at $5 billion of assets under management. There was one thing you should know about this one is it's rebalanced quarterly, and each of those holdings is rebalanced based on the forward-looking expectation for dividend payments, which this index relies on consensus analysts' expectations of what dividends will be in the future to make sure it's allocating more money to those companies likely to pay stronger dividends. This is good for high yield, for people in low tax environments where they might get a refund of franking credits, but it is again concentrated into just a few sectors. The next one I want to talk about is the iShares MSCI ESG Leaders ETF, and this is quite a long name for this one. The code for that is IWLD. This invests into global shares, so not just the US, but tracks the MSCI World ex-Australia Index, which means it has a bit more exposure to Europe and a few other areas. There are 681 holdings in this one. It costs 0.09%, so incredibly low again. And it has a 12-month return of about 15% and a 5-year return of about 19.7%. The top holdings here are very similar, although there are a few that have been removed on ESG. So ESG refers to environmental, social, and governance concerns. If they're worried about governance issues in larger businesses or control, or the pollution or manufacturing process. So the top holdings here: NVIDIA, Microsoft, Google, Tesla, Visa, Eli Lilly, the healthcare group, Home Depot, and Procter & Gamble, among others. The income, again, quite low, 1.3%, and just 1.2 billion, a significant size in assets under management in this ETF in Australia. One thing worth knowing here is that ESG Leaders means it cuts out the worst environmentally conscious companies. And this is great for global diversification with less reliance on the largest companies, but also around 34% of the portfolios in the top 10, so significantly lower than the S&P 500. The last one I want to talk about is actually an actively managed ETF, but with an external input into it, and that is the MOAT ETF. And essentially what this ETF does is it invests in an actively managed portfolio. So the team behind this ETF, which is Morningstar, a massive global research group, is trying to ascertain which companies are likely to grow more than people are expecting them to, or which are offering better value than others. And it's called MOAT because Morningstar seeks wide moats, and that's something that Warren Buffett has talked about quite a lot, being strong companies with defendable positions within their market. This one costs 0.49%, so much more expensive because there is a level of active management. There is some stock picking going on, and has 54 underlying holdings. Performance has been a bit below those alternatives because of that active management. The ETS returned 8.7% over the last 12 months and 16% over the last 5 years. And the top holdings are very different. Estee Lauder, Boeing, Nike, Applied Materials, Walt Disney, US Bank Corp. This is why it can offer differentiation to what's in those IWLD and IVV ETFs. Income is quite low, 1.56%, and the size is about 970 million, so just below that $1 billion mark. And one thing I say about this one, it is an actively managed ETF. It's looking for companies that are seen as quality and reasonably priced according to Morningstar standards. And this is probably good for those seeking a more nuanced or diversified global equity exposure, or are worried about concentrations in these other indices. And a lot of these can be worked together and built together. And one of our approaches is to build a core satellite portfolio, which combines both low-cost passive, but also allows you to smooth the ride and improve resilience of your income and growth by adding active management around that. So thanks again for listening. If there's other ETFs, strategies, investment types you would like us to cover, please leave a comment and please subscribe to the channel. And if you're looking for advice on how to build your portfolio, make sure it's set up for retirement, please reach out to our team at Waddle.